even though you're in a bull market trend, and even though you have a seasonal buy signal, it doesn't mean that you should avoid risk management, because previous deviations from the 50 and the 200-day moving average tend to correct back to that average. That's why that's called an average. Here's what you need to know before the bell this morning. Yesterday, we talked a little bit about the seasonal buy signal that's in. I got a few comments on our before the bell video yesterday. Got a couple of email questions as well. I know it's confusing, right? We have a seasonal buy signal, and then I go, okay, seasonal buy signal, markets are likely to go higher, but then I talk about managing risk because markets are overbought, extended, deviated, etc. I know those two can exist at the same time. You know, we can have a buy signal, we can have a bull market that's trending higher and still have risk. And when you see things like this, where the market's just basically accelerating higher, we're getting very deviated from the 50-day moving average, that implies that you're probably going to get some type of short-term corrective action. So even though you're in a bull market trend, and even though you have a seasonal buy signal, it doesn't mean that you should avoid risk management, because previous deviations from the 50 and the 200-day moving average tend to correct back to that average. That's why that's called an average, because prices trade both above and below that number. And once again, we are fairly deviated above that 50-day moving average. That suggests that you're likely going to get some type of pause here with the markets. Now, that doesn't mean that prices have to correct. It just means that likely prices aren't going to rise. In other words, we can go through a period of consolidation that would allow the moving averages to catch up to the market, or you're going to get a correction in price back down towards that moving average, because that's the average, and that's going to help relieve some of this overbought pressure. And by the way, if we take a look at relative strength, we are back to levels that have historically preceded some of these corrections. So yes, you can be in a bull market, and yes, you can have a buy signal that suggests that market prices will move higher over the course of the next few months. That is bullish. In the near term, you also have to be aware that markets are very exuberant and very extended for means right now, and that typically leads to a short-term corrective action that will give you a better opportunity to add money to your portfolio. In other words, buying dips, rather than buying these very sharp rallies. So while there's a lot of exuberance at the moment of people and the markets, etc., this is also the point to where, yes, take a little bit of money off the table. Don't be greedy. And again, this is going to be the whole course of our conversation this morning. There are times to take some profits, rebalance your risk back to your portfolio so that you can maintain the gains that you've built up in your portfolio, and then look for opportunities where markets correct in order to provide a little bit better entry point to put new capital, or capital that you've taken profits from, take that capital and put it to work. Again, you know, one of the mistakes that investors make is they buy, as soon as they sell something, they buy something else, and that typically doesn't work out well over time. Take one action, separate the two. One action, I'm going to sell and take some profits. I'm going to reduce risk in my portfolio, because portfolio markets are very extended right now. And then when I get a better correction or I get a better opportunity, then I'll put some capital back to work. The buy and the sell are two separate transactions. Those do not belong in the same transaction unless there's a specifically good reason for doing that. So anyway, that's what you need to know before the bell this morning.